Imagine this. You make a small decision today. Nothing dramatic, nothing reckless, nothing that feels dangerous. You decide not to invest this month, just $500. You tell yourself you'll start next month instead. It doesn't feel like a mistake. There's no alarm, no penalty, no warning notification saying this decision will cost you 6 figures, so you move on, you buy dinner, upgrade your phone, take a short trip, handle life, and nothing bad happens. That's the trap. Because the most expensive financial mistakes don't explode. They evaporate quietly. Now let me show you something unsettling. 2 people. Same age, same income, same city, same starting point. Let's call them Alex and Jordan. Both are 25 years old. Both earn $60,000 per year. Both plan to get serious about investing soon. Alex starts investing $500 a month immediately. Jordan decides to wait. Not forever. Just until things feel more stable. Until the car is paid off. Until the credit card is lower. Until there's extra. 5 years pass. Jordan finally starts investing at 30. Now pause. No one feels behind yet. Jordan isn't broke. Jordan isn't in crisis. Jordan isn't panicking. Life feels normal. But here's what's happening invisibly. If Alex invested $500 per month starting at 25, earning an average 8% annual return, by age 65, Alex doesn't just have a few extra dollars. Alex has over $1.5 million. Jordan, who waited just 5 years, about $1 million. That 5-year delay didn't cost $30,000. It cost $500,000. And the terrifying part? Jordan never felt the loss. There was no emotional pain attached to the delay. No immediate consequence. Just invisible compounding, working silently against the clock. This is the delayed consequence problem. It's not the bad decision that ruins people. It's the harmless-looking delay. Because money obeys time more than effort. And time doesn't negotiate. Let's make this even more uncomfortable. Most people don't destroy their financial future with one giant mistake. They destroy it with, I'll start next year. I'll invest when I earn more. I'll get serious after this trip. I deserve to enjoy my money now. Each sentence feels rational. Each one sounds harmless. But each one shifts the starting line further away. And in compounding, the starting line is everything. Here's the psychological twist. Humans are wired to react to immediate pain. If you touch fire, it burns instantly. You learn fast. If you overspend and nothing happens, your brain registers, safe. If you skip investing and your lifestyle doesn't change, your brain registers, no threat. But the damage isn't immediate, it's mathematical. And math doesn't send emotional signals. Let's zoom out. If you don't invest $500 this month, you don't just lose $500, you lose 40 years of compounding. The gains on the gains, the momentum of habit. The discipline of identity. You lose future leverage. And the cruel part? You can't see what you lost. It's invisible wealth. Potential wealth. Wealth that would have existed in another version of your life. Now imagine yourself at 55. You're tired. You don't want to work as intensely anymore. You look at your retirement account, and it's decent, but not powerful, not free. You realize something heavy. There was no catastrophe, no bankruptcy, no gambling problem, no dramatic failure, just delays, just small postponements, just harmless decisions. That accumulated into limitation. That's how financial stagnation is born, not in chaos, in comfort. And here's the most dangerous part. The world rewards short-term pleasure immediately. Delivery shows up in 30 minutes. Vacations create instant memories. New purchases create dopamine spikes. But investing? That reward is decades away. So your brain chooses what it can feel and sacrifices what it can't see. This is why people earning $70,000, $80,000, even $100,000 still feel behind in their 40s. Not because they failed dramatically, because they underestimated time, because they believed they could catch up later. But compounding doesn't work like that. You can increase the amount, but you can't replace lost years. And lost years are the most expensive currency in finance. Now here's the uncomfortable truth. If you're under 35 right now, your greatest financial asset is not your salary, it's not your degree, it's not your job, it's time. And every year you delay using it, you donate wealth to your future limitations. But we're not done. because investing delay is just one version of the delayed consequence trap. There's another version that's even more dangerous. It doesn't involve missing gains. It involves silent destruction, and most people are participating in it right now without realizing it, because waiting to invest is passive damage. But this is active reversal. This is compounding, working against you. Let's start with a simple scenario. You swipe a credit card for $3,000, nothing dramatic. Maybe it's a vacation, furniture, emergency repairs, or just months of "I'll pay it off soon" spending. The balance sits there. The interest rate, 22%. You don't panic, because the minimum payment says $75 due. That feels manageable, safe, controlled. And that's the illusion. Here's what's actually happening. At 22% interest, that $3,000 isn't sitting still. It's growing. If you only make minimum payments, that $3,000 can take years to eliminate, and you won't just pay back $3,000. You might pay back $4,500, maybe $5,000, depending on the pace. Now pause. You didn't invest $3,000 and let it grow for you. You borrowed $3,000 and let it grow against you. That's reverse compounding. And it's financially lethal. Remember Alex and Jordan from part 1? Alex let time build wealth. Jordan lost time and lost growth. But here's the darker version. Imagine someone investing $500 per month at 8%, while carrying $10,000 of credit card debt at 22%. They think they're building wealth. But mathematically, they're walking up an escalator that's moving down faster, because compounding at 22% destroys faster than 8% builds. This is where people get trapped. Debt doesn't feel urgent if payments are small. Minimum payments create psychological comfort. They whisper, "You're managing it." But interest doesn't care about your comfort. Interest compounds daily, quietly, relentlessly, without emotion. Let's zoom out. The average person doesn't drown in debt overnight. They accumulate it gradually. A financed phone, a car loan stretched to 72 months, buy now, pay later installments. A balance transfer that never fully disappears. Each one feels normal, culturally accepted, even encouraged. And here's the twist. Modern financial systems are designed to normalize monthly payments. Everything is framed as only $89 per month, just $220 per month. Low monthly cost. But no one asks for how long, at what interest, at what total cost. Monthly payments shrink your future before you even earn it. Let's say someone makes $75,000 per year. Sounds solid. But their fixed monthly obligations look like this. $650 car payment, $400 student loans, $300 credit cards, $250 insurance, $120 subscriptions, $2,000 rent before groceries, before utilities, before gas, before savings. Over half their income is pre-committed. Their future income is already spoken for. That's fragility. And fragility is expensive. Because when income drops, even slightly, the structure shakes. One layoff, one medical bill, one emergency, and suddenly minimum payments aren't comfortable anymore. They're suffocating. Here's the part most people don't calculate. Debt doesn't just cost interest. It costs opportunity. If someone pays $300 a month in credit card minimums for 5 years, that's $18,000 in payments. But if that same $300 had been invested at 8%, it could have grown to over $22,000 in that same period. That's a double loss. You lose money to interest, and you lose the growth that money could have created. This is the silent reversal. While you sleep, while you work, while you scroll, your money is compounding. The only question is, in whose favor? And here's the most deceptive part. Debt feels productive sometimes. You finance a car to get to work. You finance education to earn more. You justify it as an investment in yourself. Sometimes it is, but only if the return exceeds the cost. If your degree increases your income beyond the interest paid, good. If your car allows you to earn far more than its cost, may be justified. But lifestyle debt, consumption debt, that's pure reverse compounding. And it's invisible because society calls it normal. Now imagine two 30-year-olds. Both earn $80,000. One has no high-interest debt, an emergency fund, automatic investments. The other has $15,000 credit card balance, $700 car payment, minimal savings. On paper, same income. In reality, two completely different futures. One has margin, one has pressure, and pressure compounds too. Financial stress leads to poorer decisions, risky choices. Burnout job dependency. Debt doesn't just attack your wallet, it attacks your options. Here's the real danger. When compounding works against you long enough, you stop building entirely. All surplus energy goes toward maintaining. Maintaining payments, maintaining lifestyle, maintaining appearances. You're not moving forward, you're running in place. And running in place for 10 years feels like exhaustion. Now connect this back to the delayed consequence problem. Nobody opens a credit card and thinks, "This will cost me my financial freedom." They think, "I'll manage it." And for a while, they do. Until years pass, and they realize the cost wasn't the swipe. It was the time. The time interest had to grow. The time investments didn't. The time opportunities were postponed. Delayed consequences don't knock loudly. They accumulate quietly. And when they finally become visible, it feels like life got expensive overnight. But it didn't. The math was building the entire time. We've talked about delay. We've talked about debt. Now we're about to expose something even more deceptive, because this one feels responsible. It feels mature. It feels safe. And that's exactly why it's dangerous. Imagine this. You work hard. You avoid credit card debt. You don't overspend recklessly. You're careful, disciplined. You even save money every month. You open your banking app and see $12,000, $18,000, $27,000 sitting there. It feels secure, stable, responsible. You tell yourself, "At least I'm not in debt," and you're right. But here's the uncomfortable truth. If that money is sitting in a regular savings account earning 0.5% to 1%, while inflation averages 3% to 4% over time, you're not preserving wealth. You're losing purchasing power. Slowly, silently, every single year. This is the delayed consequence of excessive safety. It doesn't explode, it erodes. Let's break this down. If inflation averages 3% per year, money loses roughly half its purchasing power in about 24 years. That means $100,000 today might only feel like $50,000 in buying power decades from now. And if your money isn't growing faster than inflation, you're moving backward. Even though the number in your account looks bigger, that's the illusion. Now let's tell a story. Meet Sarah. Sarah is 28. She's responsible. No high interest debt. Good income. She saves $800 per month, but she doesn't invest because investing feels risky. The stock market feels volatile. She doesn't want to lose money, so she saves for 10 years at 1% interest. After a decade, she has roughly $100,000 saved. That sounds impressive, and it is, in discipline. But here's what she doesn't see. If she had invested that same $800 per month at an average 8% return, she'd have around $150,000 instead. That's a $50,000 difference. And she didn't make a mistake. She wasn't reckless, she was careful. But careful isn't the same as strategic. This is what makes the delayed consequence problem so powerful. You can be doing what feels right and still be falling behind. Because the real enemy isn't just debt, it's stagnation. Now let's zoom out further. Why does this happen? Because humans overvalue short-term certainty and undervalue long-term probability. A savings account feels guaranteed. The market feels uncertain. But here's the irony. Over 20-30 years, diversified markets have historically trended upward. Short-term, volatile. Long-term, growth. The risk most people fear is often smaller than the risk they ignore. And here's where it gets psychological. When you invest, the value fluctuates. It moves. Sometimes it drops, and your brain reacts to loss more intensely than gain. A 10% drop feels painful, even if the long-term trend is upward, so people retreat. Back to safety, back to stillness, back to guaranteed slow erosion. Because erosion doesn't trigger fear. Volatility does. Now imagine two people again. Both save $800 per month for 30 years. One keeps it in low-yield savings. One invests in diversified index funds. At 1% annual growth, they might accumulate around $335,000. At 8% annual growth, they could have over $1.1 million. Same effort, same discipline, different vehicle, nearly an $800,000 difference. And the tragic part? The person who chose safety felt smarter the entire time, until retirement arrives and the gap becomes visible. This is the quietest form of financial delay. It doesn't feel like procrastination. It feels like prudence. But prudence without growth becomes paralysis. And paralysis is expensive. Now let's connect this to something deeper. Most people were raised with one dominant money lesson: don't lose money. Very few were taught make money work. Those are two completely different philosophies. Avoiding loss protects you from falling, but growth builds freedom, and freedom requires growth. Here's another hidden cost. When your money doesn't grow, you must compensate with labor. You must work longer, retire later, depend more heavily on active income. Your time becomes the adjustment variable, not your capital. And trading decades of your life because your money didn't compound efficiently is one of the most expensive trades you can make. Now let's make this personal. If you're in your 20s or 30s right now, every year you delay investing isn't neutral. It's negative, not because you're failing, but because time is irreplaceable leverage. A dollar invested at 25 is dramatically more powerful than a dollar invested at 45, not because of effort, but because of duration. Duration is silent power, and once lost, it cannot be restored. So now we've uncovered 3 layers of delayed consequences: waiting to invest, letting debt compound against you, over-prioritizing safety while inflation erodes growth. But there's another layer, and this one has nothing to do with math. It has to do with identity, because sometimes the real reason people delay growth isn't fear of risk, it's fear of change. So far we've exposed the math: delay, debt, false safety. But now we're stepping into something more subtle, because sometimes the reason people stay financially stuck has nothing to do with income, nothing to do with interest rates, nothing to do with opportunity. It has everything to do with identity. Here's a question that might make you uncomfortable. How much wealth feels normal to you? Not desirable, not exciting, normal. Because whether you realize it or not, your brain has a comfort range, a financial identity, an internal thermostat, and just like a thermostat regulates temperature, your identity regulates behavior. Imagine someone who grew up hearing, rich people are greedy, money changes people, we're just not the investing type. People like us don't build wealth. We work hard. Those statements don't disappear in adulthood. They become invisible boundaries. So when that person starts earning more, instead of building assets aggressively, they unconsciously drift back to what feels familiar: spending, comfort, lifestyle upgrades. Not because they're irresponsible, because stability feels safer than transformation. This is the identity ceiling. It's the upper limit of what you subconsciously believe you deserve or can handle. And here's how it shows up. You get a raise. You could increase investing, but instead, you upgrade your lifestyle. Why? Because wealth accumulation feels abstract, but lifestyle improvement feels immediate. And more importantly, it aligns with your current identity. Let's go deeper. If your social circle spends freely, travels often, upgrades constantly, driving older cars, living below your means, investing aggressively, feels strange. It feels like isolation, and humans fear social isolation more than financial inefficiency. So they conform, even when it costs them decades. Now imagine someone who starts investing seriously. They automate $1,000 per month. They begin tracking net worth. They talk about index funds and long-term compounding. Suddenly they feel different. Different from friends, different from family, different from their old habits. And difference creates discomfort. So what happens? Sometimes they sabotage. They loosen discipline. They reward themselves excessively. They pull back. Not because the strategy failed, but because their identity wasn't upgraded fast enough to support their new behavior. This is why income magnifies behavior. If you identify as, I'm not good with money, you'll unconsciously prove it. If you identify as, I'll always figure it out later, you'll delay. If you identify as, I deserve to enjoy everything I earn, you'll resist sacrifice. But if you identify as, I am someone who builds assets, your behavior shifts automatically, not because of willpower, because identity drives action. Now connect this to the delayed consequence problem. The damage doesn't happen immediately. You don't feel your identity limiting you at 28. You don't feel it at 32. You don't feel it at 37. But by 45, the pattern has compounded. Not financially, behaviorally. You've repeated the same financial script for 2 decades. And scripts repeated long enough become destiny. Here's something powerful. People rarely rise above their self-image. If deep down you believe wealth is for other people, you will unconsciously avoid building it. You might earn well, but you'll leak money through lifestyle creep, undisciplined upgrades, avoided investing, tolerated debt. Because staying in your identity feels safer than expanding it. Let's make this concrete. 2 people earn $90,000. One thinks, I'm middle class, I spend like it. The other thinks, I'm building future freedom, I invest like it. Same income, different identity. 10 years later, radically different outcomes, and neither one felt dramatic at the start. Here's the most dangerous version of this. The I'll get serious later identity. It sounds responsible, it sounds calm, it sounds temporary. But temporary identities, when repeated long enough, become permanent. Every year you say, I'll start next year. Your brain reinforces, delay is who I am. And eventually, delay becomes comfort. Now here's the breakthrough. To break the delayed consequence cycle, you don't just change math, you change identity. Instead of asking, how do I save more? Ask, who am I becoming financially? Are you someone who consumes first or invests first? Are you someone who reacts to income or directs it? Are you someone who waits for motivation or builds systems regardless of emotion? Because systems support identity, and identity sustains systems. Now imagine something powerful. Imagine deciding, I am the type of person who invests every month, no matter what. Not when convenient, not when inspired, not when extra appears, but because that's who you are. Suddenly, investing isn't a debate. It's alignment. Debt repayment isn't punishment, it's standard. Lifestyle control isn't sacrifice, it's discipline. And discipline compounds just like money does. But there's one final layer, one that ties everything together. Delay, debt, false safety, identity, they all share a common root, a misunderstanding about time itself. We've talked about delay, we've exposed debt, we've uncovered false safety, we've confronted identity. Now everything comes down to one final truth. Time is the real currency, not dollars, not salary, not job titles, time. And most people are spending it without realizing it. Here's the uncomfortable reality. When you delay investing, you're not just postponing wealth, you're spending time. When you carry high-interest debt for years, you're not just paying interest, you're spending time. When your money sits stagnant and loses value to inflation, you're not just being cautious. You're spending time, and time is the only financial resource that cannot be replenished. You can rebuild income, you can recover from losses, you can refinance debt, but you cannot rewind compounding. Think about this. If two people invest the same total amount of money over their lifetime, but one starts 10 years earlier, the early starter often ends up with dramatically more wealth, not because they worked harder, but because they gave their money more time to grow. Time does the heavy lifting. Time multiplies effort. Time turns small consistency into massive outcomes, but time only works if you give it space. Every year you delay, you compress the timeline. And when you compress the timeline, you increase pressure. That's why so many people in their 40s and 50s feel financial urgency. They're not lazy, they're not incapable, they just ran short on time. And when time shrinks, risk increases. People take aggressive bets, chase hot investments, overextend into real estate, speculate instead of compound because they're trying to catch up. But compounding was never designed to be rushed. It rewards patience, not panic. Now here's something powerful. If you're watching this and you're still early in your career, your advantage is not your income. It's not your network. It's not even your skills. It's duration. A 25-year-old investing modestly has an extraordinary edge over a 40-year-old investing aggressively, because compounding favors the early, not the intense. Consistency beats urgency, slow beats rushed, system beats emotion, and this is where everything connects. Delayed investing steals time, debt steals time, inflation steals time, identity ceilings steal time. All of them reduce the runway your money has to grow, and when runway shortens, takeoff becomes harder. Let's shift the perspective. Most people measure financial success by income. How much do I make? But income is active. It requires your presence, your energy, your time. Wealth is different. Wealth is stored time. It represents years of discipline, years of compounding, years of aligned decisions. When you build assets, you're buying back future time. You're buying options, the option to say no, the option to rest, the option to pivot careers, the option to retire earlier. That's what wealth actually is, freedom of time. Here's the deeper truth. The reason delayed consequences are so dangerous is because they don't feel like time theft. They feel like harmless postponement. Just one more year. Just until things settle down. Just until I earn more. But years stack quickly. 5 years becomes 10, 10 becomes 20, and one day you wake up realizing you didn't run out of money. You ran out of runway. But here's the empowering part. If delayed consequences can work against you silently, they can also work for you silently. Invest consistently for a decade, and the results feel shocking. Eliminate high-interest debt early, and the relief compounds. Upgrade your identity, and disciplined behavior becomes automatic. Time punishes indecision, but it rewards structure. So what does this mean practically? It means the goal is not perfection. It's not extreme frugality. It's not overnight transformation. It's alignment. Automate investing. Attack high-interest debt. Let lifestyle grow slower than income. Build systems that operate whether you feel motivated or not. Because when your system is strong, time becomes your partner instead of your enemy. And here's the final shift. Stop thinking in terms of dollars. Start thinking in terms of decades. When you spend impulsively, ask, is this worth the future time it costs me? When you delay investing, ask, is this worth compressing my runway? When you take on debt, ask, how many months of my future does this claim? Those questions change behavior because they expose the real cost. The most expensive financial mistakes don't hurt immediately. They feel fine. They feel manageable. They feel temporary. But they quietly exchange your future freedom for present comfort, and comfort, when overused, becomes limitation. You don't need to double your salary. You don't need a lucky break. You don't need to time the market. You need to respect time. Because the earlier you align with compounding, the less force you need later. And the ultimate goal isn't just to have money, it's to own your time. Income impresses, lifestyle entertains, but time freedom changes everything. The people who understand delayed consequences early are the ones who quietly build extraordinary futures. And the clock is always running. The only question is it building for you or against you?